Farmers often need to borrow money to finance their operations. However, confusion can arise around lending documents and associated rights and obligations of the parties, one of those being a cross-collateralization clause. Roger McEowen with the Washburn School of Law joins us now with some guidance in today's Rural Money segment. Thank you so much, Roger, for being with us. Let's start with the basics. What exactly is cross-collateralization?
Well, good to be with you, Tammy. This is a term that I fear that many farmers and ranchers are not familiar with, and probably even a lot of lenders are not familiar with, but it has big implications for agricultural borrowing. A cross-collateralization clause, and what the term refers to, is a situation when the collateral for one loan is also used as collateral for another loan. For example, if a farmer takes out multiple loans with the same lender, the security for one loan can be used as cross-collateral for all of the loans.
Interesting. Now, how can this cause issues for borrowers and lenders?
Well, it causes some really serious issues, and there are several companies that are pretty aggressive, agricultural companies that sell ag products that are aggressive in using these, because it can lock out effectively a subsequent lender if a farmer has already signed an agreement with, say, an input supplier or a vendor that has a cross-collateralization clause in it. It means that subsequent lenders, even if the initial one comes in after the subsequent lender, such as the bank will be subject to all of the subsequently filed interests of the input supplier or the vendor in that instance, such as the machinery equipment dealer. And so the bank would lose out on their interest in that, even though they filed before the other interests of the lender and had an after-acquired property clause. So that's going to come as a surprise to the bank.
Definitely. Do you have an example of where this happened?
Yeah, there was a recent case just a couple of months ago in Kentucky, and a bank there found out to its detriment just how an equipment financier's cross-collateralization clause worked. And this was the first case I've seen where the input supplier, the vendor in this instance, was seeking to enforce its cross-collateralization language in what's called a multi-use agreement, kind of this line of credit that the farmer has. And before this, all I had seen was anytime the bank came in and pushed on this, the company backed down. Now they asserted it, and I think the Kentucky court was right in saying that that follows the Uniform Commercial Code in Kentucky, and it would also be the same in other states, and they upheld that cross-collateralization clause, so the bank lost out.
Yeah, definitely. You can see how that can get tricky. That's Roger McEowen with the Washburn School of Law. Appreciate your time and input today.